Okay, so let's dive in here. You've brought us this really interesting stuff on Canadian investing. And our mission today really is to cut through all that noise, give you the absolute essentials so you can be well informed, without getting overwhelmed.
Exactly. And Canada, well, it offers this mix of impressive stability, but also some unique market dynamics, things you really need to know.
Right.
So we'll explore those, equip you with the crucial insights, the economic quirks, smart tax strategies, practical steps, all from those excellent sources you provided.
Okay, good. So you mentioned Canada's solid economy, G7 nation, strong banks, those low corporate taxes. It sounds, almost ideal for an investor, doesn't it?
It certainly has that appeal, definitely. But here's where it gets particularly interesting. Canada's dollar, and really its whole economy to an extent, is what they call a commodity-linked currency.
Yeah.
Meaning, think oil, think gold, think raw materials. If global prices for those things dip, your Canadian dollar holdings, they might just dip too. And this connects directly to the stock market itself. It's heavily concentrated, really weighted towards just three sectors: financials, energy, and materials.
Right. The big ones up there.
Exactly. So that concentration, coupled with the commodity link, that's a vital insight for you when thinking about diversification.
Okay, so bearing those unique currents in mind, how does that influence your approach? Especially with, say, taxes.
Yeah, taxes are key. And Canada gives you two really powerful tools here. You've got the TFSA.
Tax-free savings account.
Right. And the RRSP, the Registered Retirement Savings Plan, the main goal for both, helping you keep more of your investment returns away from the taxman.
Makes sense.
With the TFSA, it's pretty amazing, actually. All the growth, interest, dividends, capital gains, and all your withdrawals are completely tax-free.
Wow, okay. Tax-free.
Yep. So it's super flexible, great for saving for, a down payment, a car, anything really. And that annual contribution limit, it's around $7,000 for 2025. Any room you don't use just rolls over. It builds up.
Okay, that rollover is a nice feature. And the RRSP, how's that different?
The RRSP works kind of differently. Your contributions, they're tax deductible now. So it lowers your current income tax bill, which can be a big help.
So an immediate benefit.
Exactly. Your investments inside grow tax deferred, meaning you don't pay tax on the growth year after year. You only pay tax when you withdraw the money, usually in retirement.
And the idea there is you'll likely be in a lower tax bracket in retirement.
That's the strategy, yeah. So it's often a really good tool if you're earning a higher income right now.
Okay, clear advantages to both. But that leads to the big question for you listening. TFSA or RRSP? How do you choose? Or can you use both?
Well, that's the aha moment, isn't it? It's usually not an either. They're really complementary.
Oh, okay.
Think of it like this. If your income is relatively low right now, maybe prioritize the TFSA, maximize that tax-free growth. But if your income is high, that RRSP deduction becomes really powerful for reducing your current tax bill.
So you tailor it to your situation.
Exactly. And you can absolutely use both strategically. Your strategy might even change year to year as your income or goals shift. That's where the real planning power comes in.
Right. Now, circling back to that market concentration issue, financials, energy, materials dominating the Canadian market, that feels like a classic diversification problem, doesn't it? How do you manage that risk effectively?
Yeah, it is a real consideration. And this is where ETFs, exchange-traded funds, have become, kind of the standard. They're low cost. They give you instant broad market exposure. Super convenient.
Okay.
And specifically for this Canadian concentration issue, we often recommend looking at all-in-one global ETFs. Think tickers like XEQT or VEQT.
I don't know what those do.
They automatically invest your money not just in Canada, but across the U.S. and internationally too. All in one fund. It directly tackles that home country bias and concentration risk, gives you that crucial global diversification you need.
Got it. So ETFs are a key tool there. What about taxes on the investment earnings themselves? Any key things you need to know?
Yeah, a couple of quick practical points. First, capital gains. When you sell an investment for a profit, only 50% of that net profit is actually added to your income and taxed.
Okay, a 50% inclusion rate.
Right. And dividends. If you're getting dividends from Canadian companies and you're a non-resident, there's typically a 15% withholding tax. That's thanks to tax treaties. Now, here's a really important one for U.S. stocks. If you hold U.S. stocks that pay dividends, the default withholding tax is 30%. But you can get that reduced to 15% by filling out a simple form. It's called the W-8BBEN form. Basically, you're just certifying you're not a U.S. resident for tax purposes.
W8BN. Okay, that sounds like a key action item for anyone investing internationally from Canada.
Absolutely. Don't leave that extra 15% on the table.
Good tip. All right, final practical piece.
Mm-hmm.
Where do you actually, do all this? Choosing a broker. Any pointers there?
Broker choice does matter, yeah. For beginners, Wealthsimple often comes up. It's very user-friendly, easy interface, and they offer free trades for Canadian stocks and ETFs, which is attractive.
I sense a but.
Yeah. The but is their currency exchange fee for U.S. stocks. It's around 1.5% each way buying and selling. That can really bite into your returns if you trade U.S. stocks often.
Ouch, okay. Good to know. What's the alternative?
For more experienced folks or people trading more frequently, especially internationally, Interactive Brokers, or IBKR, is often recommended. Their platform is maybe a bit more complex, but their fees are generally the lowest across the board. And crucially, their currency exchange fees are much, much lower than someone like Wealthsimple.
Okay, so Wealthsimple for ease and Canadian trades. IBKR for lower costs, especially with U.S. stocks.
Got it. So pulling it all together, investing in Canada, it's clearly not just about picking stocks. It's about really understanding that unique economic rhythm.
Yeah, that commodity link.
Mastering those tax advantages, TFSA, RRSP.
Using them strategically.
And then diversifying properly, likely with those global ETFs.
Yeah.
With these insights, you really are much better equipped now, aren't you? Absolutely. And maybe the final thought to leave you with is this. Consider how understanding these specific Canadian nuances, the commodity dollar, the TFSA rules, the market structure, how that kind of detailed understanding can actually sharpen your thinking for analyzing any market you look at globally in the future. It builds that critical investment muscle.